Yo, what's up, everybody? It is Tuesday, September 10th. Tomorrow's 9/11. Man, 23 years. 23 years. And I remember that day like it was yesterday. I was down there on that day, saw the towers come down. Anyway, tomorrow's the 23rd anniversary of 9/11. All right, let's talk about the markets, folks. Yesterday we had a $12 billion net drain. We're going to see these net drains now because we're leading up to the September 16th quarterly corporate tax drain. So likely to get some volatility. I would be a little bit cautious about the rally. But next week, next Wednesday, the Fed will cut interest rates. Right now it looks like a 25 basis point rate cut. And it will trigger, monetarists, they will buy. I mean, we will get a pop off of that. And like I've been telling you guys, everything changes once the Fed starts cutting rates. Now, it doesn't mean, that the change is going to happen like instantaneously, but conditions will begin to change. We're going to see that in the fiscal flows. We're going to see it in the Treasury statement data. And I will be monitoring that as I always do on a daily basis. And we will start to see how those interest income transfers will start to slow down relative to last year once the Fed starts cutting interest rates. So I've been telling you guys that, and it's something to keep in mind. Economy growing around 2%. We've had $1 trillion worth of interest income transfers this year, this fiscal year, which isn't even over. I mean, we still have a couple more weeks left in the fiscal year. $1 trillion in interest income transfers, and the economy is only growing at 2%. And now you're going to start to reduce that. I've been using the analogy of you stepping your foot on the brake. Your car's going at a certain speed. You start to slowly apply the brake. And what happens, it starts to slow down. You're not slamming on the brakes. Slamming on the brakes would be like a major, balancing the budget or running surpluses, monthly surpluses, government surpluses. That would be slamming on the brakes and the emergency brake and hitting like a brick wall. But we don't have that condition, but we have a slow pressure on that brake, and it's going to slow down the economy. And then I've been talking about going into next year. We got a bunch of fiscal drag that's going to start to hit unless there is a policy response. That's going to depend on the election and Congress. So there's a lot ahead of us. I would just say that right now, if you were going to take a snapshot of right now and say those are the conditions starting now, with the rate cuts going into next year, with the fiscal drag, it's going to slow everything down, and the stock market is going to reflect that. Remember, I'll say it again. Stocks follow the economy. One thing I want to talk about today is the drop in oil prices. It's interesting what's going on. I mean, right now, and I've been commenting on this now for a while, that oil producers hold a record net long futures position in WTI, okay, in the NYMEX contract. Record net long, 150,000 contracts net long. That's longs minus shorts. And they've been long since May 2023. So basically we're talking about, 16 months that they've been holding a net long position. And prices have been coming down. We were in a kind of a trading range between 70 and 80. Every time it got up around 80, they were selling. Every time it got down around 70, they were buying. But now we're at 66. We've been at these prices before. We've seen in the petroleum data that comes out weekly a precipitous decline in crude inventories. I think there's something at the lowest level in 16 or 19 months. I have to go back and look. We just had another draw that came out in the API inventories this evening or earlier today. tomorrow we'll get the Energy Information Administration's weekly report that comes out, and we'll see what it says in there. Net exports of crude and petroleum products are very strong. We've been in a period where they had been kind of easing back, but now they've come back very strong. So fundamentally, I mean, gasoline product demand is decent. We've actually seen a pickup in distillate demand. So the supply demand data that we get to see, it's not bearish. It's definitely there are numbers in there that definitely you could easily argue are supportive for petroleum prices. By the way, we have this tropical storm Francine, which I think they're saying is going to turn into a hurricane. They're shutting down production in the Gulf. Oil producers are, so that's a factor. But the market sees this. So far, there hasn't been any reaction. I am still bullish, but I have to say that I understand that some of this recent selling has been tied to, the outlook for a slowdown in the economy. Definitely you have oil traders who look at what's going on in equity markets, and that, we had that big sell-off recently in stocks. So I understand, the dynamic playing out here, at least on a short-term perspective with respect to prices. Again, fundamentally, unless we see a very significant contraction in the economy, I mean, we're still growing at 2%, and once the rate cuts hit, that's just going to be a gradual, pressure on the brake, like I've been saying. I think we've been at these levels before. We were at these levels in 2021. We were at these levels in 2022. We were at these levels last year. Every time we got down here, oil has bounced back up. So it's hard for me to get bearish on oil when I see producers, and I've spoken about this many times in the past. I don't go against what producers are doing. They're the most savvy players in the physical commodity markets. They're in the business of producing and merchandising and trading the physical commodity. And I've even talked in the past of my own experiences as a floor broker on the NYMEX. I was executing business for oil companies, and I saw how savvy they were, okay? Sometimes the timing is not exactly on point, but that's because they generally look to scale into their position, either if they're selling or if they're buying. So I'm staying bullish on oil. I bought some more oil stocks as they're coming down here right now, and I think I'm going to be fine on that. I don't have any discomfort with respect to doing that, and I'm going to continue to do that. So tonight is the debate. All right. Very close, both Trump and Harris in the polls. The debate might push, one side higher up than the other. We'll see how it goes. Trump is a pretty good debater. So we'll see how that goes. And of course, next week is going to be a big week because we have the tax strain on Monday. And then, of course, the Fed rate cut, which is going to, that'll take over everybody's attention. Right now, the market is forecasting a 25 basis point rate cut. Maybe a little bit disappointing to the market, but I still say that the monetarists will get triggered by this. They will buy any rally, and I'll say this now up front, any rally that we get in stocks off of the rate cut, and it could last several days, it could last a week, whatever, is a temporary rally, because I'll repeat it one more time. Rate cuts are right now the change in fundamental conditions that we have not seen in a long time. It is a change in the fiscal dynamic in the market. And it's going to play out. They don't do one rate cut. They do a rate cut. There's the impact of the rate cuts, which is lowering prices, which is the removal of some of that interest income transfer, which is a slowdown in the economy, which is a drop in inflation, which is ostensibly what they're trying to do. And they're going to look at that, they're going to cut again, and they're going to cut again, and they're going to cut again. And when they do come through with these successive rate cuts, that's more braking pressure on the economy. So we're gonna see this all play out. I said to you guys many times now, we're gonna come back and revisit what I've been telling you, several months down the road, 6 months down the road, whatever. I'll come back and I'll say, remember those videos that I was doing in July and August and September, how I was telling you that the rate cuts were not going to be bullish, that it was going to slow down the economy, that it raises the probability of a recession in 2025. Not even talking about the additional fiscal drag that's going to come about next year unless it is addressed by policy. So we'll see. Anyway, that's it for today, folks. Please like and subscribe. Thank you very much if you've already done that. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT and I show you, I educate you, I show you how to use that to trade and invest profitably in the financial markets. See you tomorrow. Bye.